Hi, I'm Dean, and today we're talking asset finance. It can be key to growing your business, but it can also be tricky to understand the details and types, but that's exactly what we're here to help with. For those that don't know, I'm the credit analyst team captain here at iwoca, and it's my job to suss out a customer's credit status when they make an application. Getting back to topic, asset finance, in short, is a type of loan. And to kick us off, we need to know one key thing. What does your business need which it doesn't sell? This may sound like a bad riddle, but any physical item that fits this description is an asset. From tech to tools to tables and chairs. Or a trampoline, if that's how you do business. Think of a butcher, a baker, and a candlestick maker. A butcher's assets will be their refrigerator, their mincer, their sausage machine. A baker's assets, their oven, their tins, and rolling pins. You get the idea. Now we know what an asset is, imagine this scenario at the bakery. A few customers are late paying their invoices and disaster strikes. The baker's oven packs in, and it urgently needs replacing. If he doesn't have the cash up front, he may need asset finance to keep his business baking. The three most important things to remember are, number one, if your business simply doesn't have the cash up front, you may need asset finance to get that equipment to keep your customers happy, like our friend the baker. Number two, asset finance is a loan specifically used to buy, lease, or replace existing equipment in the business. Number three, asset finance can be used to unlock cash from existing assets already within the business, and I'll explain about that later on in the video. Let's have a look at the 5 main types of asset finance: hire purchase, equipment leasing, finance leases, operating leases, and asset refinancing. Don't worry if that sounds like a lot to remember, we'll go through that in more detail now. First up, hire purchase. This is a really common type of asset finance, a little like a mortgage on a house. You'll own the item immediately by paying a small upfront deposit, then transfer monthly installments with added interest to spread the rest of the cost over time. Hire purchase agreements generally last between 1 and 6 years, and you'll be responsible for maintenance and insurance costs. Sometimes it doesn't make sense to own an item outright, in which case you have equipment leasing. Effectively, you rent the item, paying monthly installments whilst you're using it. It's a really flexible type of asset finance. For example, if you don't need the equipment permanently, or if you're thinking you'll need to upgrade the kit next year. At the end of the lease term, there are a wealth of options. You don't need to return the asset if it's become vital to your business. You can extend, upgrade, or even buy the item outright. A finance lease, also known as a capital lease, is almost a halfway house between the two previous options. You'll be in possession of the asset for most of its lifetime, but you'll never own it outright. It's a long-term lease that has the benefit of spreading payments thinly, so you only have to pay small monthly installments. So if you don't have the cash up front, or you're thinking of keeping the asset for years to come, this could be perfect for you. An operating lease is pretty similar to a finance lease, but with a caveat. With this type of asset finance, the company you're leasing from is responsible for maintenance costs. For example, if you're leasing a printer and you buy the toner and paper, if it stops working, the company you're leasing from will come and fix it. At the end of the lease, the company will come and take it back, or you can extend the lease. It's a great option, but the maintenance cover will be reflected in an increased monthly cost or interest rate, so you'll need to take that into account. And last but not least, asset refinancing. This type of asset finance can be used to unlock money from equipment you've already invested in. Put simply, you can sell some equipment you already own to a lender who then leases it back to you over a fixed period of time. This allows you to unlock some of the cash you used when you first bought it. For example, our butcher from our earlier story may choose to sell his sausage maker to a lender and then lease it back for a fixed amount each month. This means that he can buy the meat he needs to fulfill a big order with no disruption to his business. So that's asset finance in a nutshell. It has the advantage of flexibility and removing big upfront costs when you need to buy for your business needs. On the flip side, it can be more expensive than simply buying the item up front. Ultimately, every business is different. So it's up for you to decide whether asset finance is right for you and which type you'll need. If you've enjoyed this video, do watch the others in our Finance Explained series and let us know what you think via our social media channels.